Hello, everyone. Welcome back to CAMPHAM Channel, where we share valuable knowledge from famous books on finance, investment, and personal development. If in the first two volumes of Rich Dad, Poor Dad, author Robert Kiyosaki helped us distinguish the different mindsets between the rich and the poor, as well as the fundamental principles of money management and cash flow creation, then in Volume 3, Rich Dad's Guide to Investing, the content has been taken to a higher level. This is a book not only about how to get rich, but also about the mindset of a professional investor, the necessary steps for each person to build a solid financial path for themselves. Kiyosaki emphasizes that becoming a successful investor does not start with how much money you have, but more importantly, how much knowledge, experience, and risk control ability you possess. In today's video, we will summarize the main ideas of Volume 3, including the investment mindset of the rich, the three types of investors, the difference between investing and speculating, and the fundamental principles that Rich Dad wants to pass on to anyone who wants to embark on the true path of investing. If you are looking for a guide to escape the endless cycle of daily work and truly want to build a financially free career, then this video is definitely for you. Let's get started right away. When it comes to investing, most people often simply think that as long as you have a lot of money, you can participate. However, according to Robert Kiyosaki, the mindset of the rich is completely different from the majority. The rich not only think about how to make more money in the short term, but they focus on building systems and creating long-term, sustainable cash flow. The biggest difference lies in the fact that the poor and middle class often focus mainly on income from wages. They spend most of their time and effort working hard, trading time for money. Meanwhile, the rich focus on building income-generating assets, things that can create money even while they sleep. This is the key difference that Kiyosaki wants readers to realize. He emphasizes that before becoming a good investor, you must learn how to manage money, understand cash inflows and outflows, and more importantly, know how to accept risks intelligently. The rich do not avoid risks, but they learn how to control them. On the contrary, the poor or those without knowledge are often fearful of risks or plunge into investing blindly, only to easily fail. Another mindset that Kiyosaki mentions is always learning and investing in oneself before investing externally. The rich see reading books, attending courses, gaining real experiences, and building quality relationships as the most important investments, because it is knowledge and experience that help them see opportunities others miss. In addition, the rich always think in terms of creating systems rather than working alone. They not only invest money, but also know how to leverage the time, effort, intelligence, and resources of others. This is why the rich often own businesses, companies, or investment funds, models capable of generating continuous profits. In summary, the mindset of the rich about investing does not stop at having money to invest, but lies in knowing how to create assets, manage risks, and continuously learn to build a sustainable financial system. This is the important foundation for us to further explore the types of investors that Kiyosaki analyzes in the next section. In Rich Dad, Poor Dad, Volume 3, Robert Kiyosaki points out that not all investors are the same. In fact, there are many types of people participating in investing, but he divides them into three main categories for us to better understand: accredited investors, professional investors, and inside investors. Understanding these differences will help each person shape the path that suits them. The first type is the accredited investor. These are people who usually have large capital, high income, and meet certain legal standards. They have access to investment opportunities that ordinary people find difficult to reach, such as private equity funds or special projects. However, having a lot of money does not necessarily guarantee success, because without knowledge and experience, they can still lose as usual. The second type is the professional investor. This is the type of investor that Kiyosaki advises everyone to aim for. Professional investors not only have capital, but more importantly, they have deep knowledge, know how to read financial statements, analyze markets, manage risks, and control emotions. They treat investing as a real profession, continuously learning and honing their skills. As a result, they can see opportunities the crowd misses and make decisions based on reason rather than emotion. The third type is the inside investor. These are people who directly build businesses, create value from within, and at the same time are also investors of their own ventures. For example, an entrepreneur who starts a company and reinvests profits to expand. They are both the owner and the inside investor. The advantage of this group is that they clearly understand the system they are operating, thereby controlling risks better than investing in places they do not understand. The key point that Robert Kiyosaki emphasizes is aim to become a professional investor rather than just a passive funder or someone following trends. A professional investor combines knowledge, skills, and experience, thereby turning risks into opportunities and ensuring that cash flow always runs in the right direction. This is also the mindset that Rich Dad wants to pass on to the next generation. Investing is not a game of luck, but a process of training to elevate yourself to a completely different level. One of the most common mistakes Robert Kiyosaki points out in Volume 3 is that many people often confuse investing with speculating. At first glance, the two concepts may seem similar, both involving putting money out with the hope of making a profit. But in reality, their nature is completely different. Investing is a process with a plan, research, and a long-term vision. Investors spend time carefully studying the market, analyzing numbers, considering cash flow, and most importantly, making decisions based on knowledge and preparation. When investing, the main goal is to create stable, sustainable, and long-term cash flow. Investors understand that profits will not come overnight, but if the foundation is built correctly, their assets will generate continuous returns over time. On the contrary, speculation is often associated with luck and temporary emotions. Speculators often follow rumors, chase the crowd, or expect price increases in the short term without clear analysis. They are more like betting their money rather than truly investing. And because of the lack of knowledge foundation and long-term planning, the risk of loss for speculators is always very high. Kiyosaki emphasizes that the rich do not gamble with their money. They do not jump into an opportunity just because they hear others talk about it or because they see everyone rushing in. Instead, they patiently analyze, only investing when they understand clearly and can control the risks. For them, money must serve a larger purpose, building financial freedom, not seeking short-term excitement from market bets. In short, the core difference between investing and speculating lies in mindset and approach. Investors look far, build a foundation, and stick to their strategy. Speculators chase quick profits and often pay a heavy price. If we truly want to escape the financial rat race, each of us needs to learn how to become a true investor instead of a blind speculator. Before jumping into any investment, Robert Kiyosaki emphasizes that the most important thing is to build a solid foundation. He believes that many people fail not because the investment opportunity is bad, but because they are not adequately prepared in terms of knowledge, experience, and relationships. Therefore, Rich Dad laid out 3 foundational factors that anyone who wants to succeed in investing must equip. The first is financial education. This is the most important foundation. If you don't understand cash flow, financial statements, expenses, profits, or taxes, then investing is like walking in the dark. The rich see learning about finance as an investment in themselves, because with knowledge, you will know how to spot opportunities, calculate risks, and make the right decisions. The second is real experience. Kiyosaki believes you cannot become a good investor just through theory. You need to start small, with investments within your means, to learn. Even failure is a valuable lesson that helps you grow. The rich are not afraid of mistakes. They only fear not learning from them. Real experience transforms knowledge into skills, and skills into confidence. The third is relationships. In investing, no one can succeed alone. The rich always understand that the power of a network is extremely valuable. A good relationship can bring you opportunities, information, or trustworthy partners. Therefore, build and maintain relationships with people who share the same mindset, goals, and experience, rather than only casual social connections. Kiyosaki once emphasized, investing is not just about how much money you have, but more importantly, how much you know and who you know. With solid knowledge, experience, and networks, you will confidently step into big opportunities instead of being fearful or passively following the crowd. In short, before thinking about making a lot of money from investing, ask yourself whether you have prepared enough foundation. Because it is the foundation that determines the sustainability and longevity of any financial journey. At the end of Volume 3, Robert Kiyosaki shared the key advice he learned from Rich Dad, foundational principles that anyone can apply on the path to becoming a successful investor. The first piece of advice is, the rich invest in businesses and systems, not just individual assets. Instead of focusing only on buying stocks or real estate and waiting for the price to rise, they focus on building systems that generate sustainable cash flow. For example, a successful business can bring stable monthly profits, while the value of the company still gradually increases over time. The rich understand that businesses and systems are the foundation of wealth, not quick speculative deals. The second piece of advice: focus on cash flow, not just asset value. Many people often only look at whether an asset increases in value, but Rich Dad emphasizes that what matters more is whether the asset generates regular cash flow. A rental apartment that provides monthly income is much better than a vacant property that only increases in value on paper. The third piece of advice: act early and be persistent. The rich do not wait until they have a lot of money to invest, but they start as soon as there is an opportunity that fits their ability. What matters is developing the habit of consistent investing so that each experience becomes a lesson. Over time, persistence turns small investments into great assets. Finally, Rich Dad always emphasizes, learn from mistakes. No successful investor has never failed. The difference is that the rich know how to draw lessons, adjust strategies, and keep moving forward, while many others give up after just one failure. In short, Rich Dad's advice revolves around 4 pillars: invest in systems, focus on cash flow, act early, persistently, and learn from mistakes. This is the compass for anyone to gradually escape the financial rat race and move toward true freedom and wealth. Thus, through the lessons in Volume 3, Guide to Investing, Robert Kiyosaki has shown us that to become a successful investor, money is not the deciding factor. More important are mindset, knowledge, experience, and the ability to build systems that generate sustainable cash flow. The rich are different, not because they start with more money, but because they have a broader vision, know how to accept risks wisely, and persist on the path of learning. In summary, 3 key points you need to remember are: 1. Invest in yourself first. Learn, practice skills, and build relationships. 2. Focus on income-generating assets. Create regular cash flow instead of only chasing appreciation. 3. Act early and persist. Start small, learn from mistakes, and keep moving forward. If you are looking for a path to escape the daily grind and build financial freedom, then the lessons from Rich Dad will surely be a valuable guide. Thank you for watching the summary video of Rich Dad Poor Dad Volume 3 on CAMPHAM Channel. If you find this content useful, please give it a like, share, and don't forget to subscribe to the channel to support me and not miss the next great book summaries. Do you want me to continue with the summary of Volume 4 of the series? Leave a comment below.